I'm Jamaal, one of the faculty members here with Rule 1, and we're going to have a little talk about dividends. Dividends are payments, usually in cash, that companies make as a return of capital to their investors. It's a way for companies to return capital back to investors. Typically, these dividends come out in the form of, a cash payment. Might be on a regular schedule like every quarter or every month. And occasionally you might have a special dividend that comes out maybe once a year based on whatever circumstances. Maybe a lawsuit ended or something like that. The company did really well, whatever the case. Every now and then a company has a specialty dividend. But normally when you're referring to dividends, these are cash dividends that people are referring to that are typically paid out once a quarter by most companies. The significance of dividends. This is a very interesting question. So there are investors out there who are looking for income, and investing in companies that pay strong dividends is very attractive to them. However, at Rule 1, we do things a little bit differently. We like to find wonderful companies, whether they pay a dividend or not. Berkshire Hathaway famously does not pay a dividend. It hasn't for years. Chipotle Mexican Grill does not pay a dividend, and they've been just doing amazing for years and years. So as a Rule 1 investor, we don't go targeting companies that pay dividends. We go find wonderful companies and we buy them on sale. In fact, we would almost prefer a company to not pay dividends, because if that company pays us a dividend, well, we've got to deal with taxation, right? So that's one thing we've got to deal with. We've got to pay taxes on it, and the company has to pay taxes on it. We also have to figure out what to do with the money, right? And the company, is that the best decision for them to make? Are they giving us that cash dividend because they have so much excess cash that they don't know what to do? Or is the company out there borrowing money to be able to pay a dividend? And this is extremely important for us to know, because a company that's borrowing money to pay a dividend, like GM 10, 15 years ago, is a company could find itself facing bankruptcy, versus a company that has a strong performance history, strong cash flow. The company's taking care of all their debt responsibilities. The company is reinvested in growth and still has a bunch of cash left over. They don't know what to do with it. Okay, fine, I'll take the dividend. I'll take it, but we prefer them to reinvest it into the company to keep the company growing and moving forward. That would be our preference as a rule. So management and the board of directors are the ones who make a decision about dividends. So the board normally decides, yes, we are going to pay a dividend, or no, we are not going to pay a dividend. This is how much we're going to pay in that dividend. And it may be something like 50 cents per share, $1 per share, whatever they decide. And that's going to equal up to a total amount that they want to spend on their dividend program. So that's something that the board puts out. Dividends are not automatic. They can be adjusted. If a company is struggling, they can cut the dividend. If the company has a great year, they can raise the dividend. So oftentimes we'll see dividends adjusted based on how a company's doing. What's better, compound interest or dividend payouts? I'll take compound interest all day long. All day long. I want to see that money compound over time at a nice rate. 15% or better would be great. And then be able to appreciate that money down the road, versus dividends that I'm going to have to pay taxes on every year. Dividends typically are a small return of capital to investors, and I think I can do much better as an investor on my own as opposed to relying on just those dividends.